Welcome everybody to this episode of the GrowingAU show, where we are going over some of the stock market's winners and losers to determine the best place for you to put your money to get the most returns out of your investments. After all, the best way to make sure that your money works for you is to know how your money works. So we're going to be going over some interesting stuff today in today's episode. Most of you, if you're into investing, if you're into the stock market, you've probably heard of the Motley Fool before. They predicted Apple's growth, they predicted Amazon's growth, and multiple other great investments as well. And we're going to be talking about a recent list that the Motley Fool just released of the 5 stocks to get into under $50 to make money in the stock market. Now, here's the thing. Most of the time that these lists come out, the results of those lists can vary quite a bit. So what we're going to be doing today is actually looking at the facts of the companies that are recommended by the list by the Motley Fool to see whether or not this is the places that we want to be placing our money in the stock market. We're going to see if there's any value behind it. So let's just roll that intro and jump on into the video. So before we go over the actual stocks included in Motley Fool's list, I just want to say really quickly, this video is sponsored by the like button. So if you wouldn't mind hitting that like button down there, helping us with the YouTube algorithm, I would really appreciate it. And it helps us all keep making videos like this one and bringing you the cold hard facts regarding the stock market. So if you hit that button below, really appreciate it. So what are the actual companies that are being included in the Motley Fool's list? Well, it's five different companies. The first one being Slack, then Zynga, Hawaiian Holdings, Charlotte's Web, and another company called Stitch Fix. We're going to be going over all of those today. And in fact, Zynga is a company that I actually hold stock in. Now, to be fair, I didn't actually buy any of the stock that I currently hold in Zynga. Well, how did I get the stock for free? Well, the wonderful thing is when you sign up for Robinhood, you will actually get a free share of a stock. So that's what I did with Zynga. I signed up for Robinhood and got a free share. Well, what about the other 4? Well, what I did was I shared out my link to other people, and that allowed me to get an additional share for everyone that signed up using my link. Robinhood is one of the greatest online brokerages. It's a great way to get started in the stock market. You can get a free share in any stock ranging from Zynga all the way up to Apple, Microsoft, Berkshire B, stuff like that. I've personally received a free share of Microsoft before, now worth upwards of $140. So if that is something you're interested in, if you're interested in getting a free share, stick around to the end of the video. I'll tell you how to do that. And if you don't want to wait till then, top link in the description. So let's look at Zynga. Let's just jump in and to see what they are all about. So for those of you who don't know, Zynga, ticker symbol ZNGA, here's what this company is. So it's a leading company in the mobile gaming market. They IPO'd in 2011 in July at $10 a share. They were really associated with Facebook. They had a lot of ties to Facebook. And a lot of people thought that would be a good thing. Well, maybe not so much, because they cut their reliance back on Facebook in 2012 when their stock started to hit a low point. They decided that we need to make a change, something else needs to happen here, so they started to cut that reliance on Facebook. So they created games that you might have heard of, including Words with Friends and Empires and Puzzles. Very popular games. If you look up Zynga on Google, the amount of games that they have created is just incredible. The portfolio of creation that this company has done is really great, and one of the reasons they've been able to do that is because of their strategy that they focused on in the last couple of years since 2012, and one of the strategies that I personally think has made them so successful. What Zynga has done is they've actually gone out and started to acquire other small production companies and allowed them to produce the games. So they've gone out, they've acquired the companies, they've had now a stronger workforce and allowed them to produce more product under their house. So Zynga's been really making some smart moves in the recent. As I said, they focus on the acquisitions and mergers. They are now acquiring proven winners, developing smart marketing, and signing leasing deals to give them an edge over the other producers in this market. And as I said before, they are one of the leaders in an industry that is worth up to $138 billion. So they're really doing well and doing big things in the mobile gaming industry, which we've seen to be growing in popularity over the last couple of years. The company's CEO is Frank G. Gabio with 1,883 employees. For this year, they are currently up 27.75%. And for the last 5 years, they are up, get this, 191.63% up over the last 5 years. Experts are giving them a 76% buy rating. One of the most recent things that Zynga has done is they partnered with Amazon Prime through their mobile gaming app. And what this has done is allowed Amazon members who have Amazon Prime have been able to get free services and kind of upgrades and stuff like that within the game. So a really strong partnership with Amazon there. The only thing that we need to talk about, though, is that they've missed their earnings per share expectations over the last 6 quarters. So definitely a little bit of a, not a completely clean slate for the company, but I mean, up 191.63% over the last 5 years, up 27.75% this year alone. They've seemed to have a really good track record and are really dominating in the mobile gaming industry, which does continue to grow and gain popularity. So how is Zynga sitting today? Well, to be fair, The market is closed today. We are recording this on a Sunday, but current stock price of Zynga is $7.32. Zynga, I gotta tell you, of all the companies on this list, is one of the ones that I am most excited about. So that's them. Definitely recommend doing more research before you jump in and decide to buy shares in that company, but that is how Zynga is doing. So definitely feel free to check them out if you are interested, if you want to invest in the mobile gaming sector. Moving forward, another company in the mobile sector, we have Stitch Fix. Their call sign is SFIX. And so what this company is, they were founded by Katrina Lake in 2007. They are an online personal styling service that you can essentially use and leverage through their app. What really makes this business stand out in this sector is not only its personal expertise, but its use of sophisticated proprietary algorithms. As we know, when it comes to the online sector, algorithms are where it's basically all at nowadays. If you're into marketing at all, you're probably hearing about the changing in algorithms all the time, and Stitch Fix is using it to their advantage. Currently have 8,000 employees for an online styling service. That is that's crazy to me. They IPO'd at $16.90 on November 17th, 2017. They are down 6.63% over the last 5 years and down 40.81% over the last year. If we do want to go ahead and take a quick look at their stock, again, remember that the market is closed today. They are currently at $15.78. Going to definitely turn some people away. Doesn't mean that it couldn't have a resurgence in the future, but you just have to determine whether or not that's a risk that you want to take on Stitch Fix. But moving on to the next one, we have Hawaiian Holdings. Now, Hawaiian Holdings is a holding company that deals with mostly air travel to Hawaii and a few other locations. Their stock right now is the cheapest that it's been since 2015, and that's due to several factors. One of those rising factors is competition. They've experienced a lot of competition in the recent years, and that's really affected the company's stock. Despite that, the company does hold a dominant position in the growing market space with over 80% of the market shares. Peter R. Ingram is the CEO of a 7,437 employee company. They have a 22% buy rating, so definitely not as high, definitely one of the lower buy ratings on this list, because after all, they are down 54% over the last year, and they're down 45% over the last 5 years. If you want to look them up, their ticker sign is HA. They are currently at $12.98 per share, and had a high point back in 2016 around $57 a share. So again, significantly down since then. And as we stated here, they're down 54% over the last 5 years. So definitely you got to decide whether or not you think that this company with more research is going to have its resurgence as the Motley Fool suggests. The next company we want to talk about today is actually the only over-the-counter stock. It's not listed on one of the common exchanges, and that is Charlotte's Web. Now, what does Charlotte's Web do? A lot of people have been paying attention to the cannabis market recently. It's no doubt that it has the potential to be one of the next booming industries. After all, it was just legalized in Canada last year, and assuming that the United States is not far behind that, the cannabis industry could really see some massive growth. And Charlotte's Web is one of those companies that are being lumped into the growing companies that have really started to see a resurgence in their shares and stock prices since Canada legalized marijuana. So how does Charlotte's Web differ from any of the other companies like Aurora Cannabis or any of them? Well, Charlotte's Web mainly produces CBD, which is a marijuana extract with minimal THC. THC is the chemical that is responsible for the psychedelic effects that come with cannabis. They are producing with as minimal THC as possible. So I guess, as I said, they've been lumped into the companies that have taken off since Canada's legalization of marijuana last year. That they have a huge start in the pioneering market. That's one of the reasons the Motley Fool likes them, is they have a huge start in the pioneering market. They believe that this company could really make some leaps and bounds. If we're looking, they are traded over the counter, so that's how you have to decide whether or not that's something that you want to get into. I know some people don't want to have anything to do with over-the-counter stocks, so you have to decide whether or not that's something you want to do. Real quick, I will say there's going to be some brokerages, like Robinhood, for example, that you can't really get involved with over-the-counter stocks, so you're going to have to go with a more traditional brokerage like Fidelity. Deanie Elsner is the CEO, and as we said before, they are in a possibly wonderful position to capitalize on the rebound of the CBD market, specifically if and when the United States does move forward and legalize the cannabis-related products. Again, you're going to have to decide whether or not that's a risk you want to take. I know one of the problems with the cannabis stock right now is the fact that a lot of people are producing it, but the issue is that not a lot of people are buying it. So you're getting massive amounts of product that aren't being bought, which is lowering the overall price, and that's been something that's been affecting shares. Now, that's something that could be fixed with Canada's legalization and then possibly the future subsequent U.S. legalization of marijuana. So we'll have to wait and see how that goes. Charlotte's Web, if that's an industry you think is going to boom, if that's an industry that you think is going to really take off over the next couple years, Motley Fool is marking Charlotte's Web as a possible, leading company in that sector. So I definitely recommend, again, with all of these, every single one of them, you got to do the research. I'm just trying to get you understanding what Motley Fool is possibly suggesting here. If you're into that type of thing, it could be a good place to start. So the last company we want to talk about today has a ticker sign WORK, that's work, and that is Slack. So what is Slack? Well, they are an email and workspace communication company that has worked to combine various types of communication and file sharing management for business. They've doubled their revenue in fiscal year 2018 and more than 80% in 2019. So obviously a very profitable company. They're doing a lot of really great things. And they've had $504.7 million in revenue last year. And they're operating in the largely untapped $28 billion workspace communication industry. And they're one of the leaders in that industry. Some of the issues that they've had over the last couple of years is that they've been kind of in competition with Microsoft. Microsoft has been, as we know, like Microsoft has their team platform. Daniel Stewart Butterfield, the CEO of Slack, doesn't necessarily think that Microsoft is a competitor. So just some last few things about Slack. What the bulls are saying, again, from Morningstar.com. They have a fast-growing user and financial base. They have a low-touch, low-friction business model, and they are the forefront in emerging market. The bears are complaining that Microsoft is using Team to compete, and Microsoft already has more active users. They don't have to worry on that customer acquisition quite as much, and Slack is not yet profitable, and the model does not even contemplate the profitability in our bull case until fiscal year 2025. That's something that is the bears are having issue with. And again, as we said before, they just have the one product, so they don't have a way to further penetrate customers. Slack is a definitely interesting one. They have only been on the market since June 20th, 2019, when they DPO'd instead of an IPO. Of all the companies that the Motley Fool suggests, Slack is by far the most new and the one that we really just don't know a lot about yet as far as how the market is going to treat them. It could be very interesting, as we've seen with this whole kind of shelter-in-place, work at home, seen over the last couple weeks. Companies like Zoom, Microsoft, now Slack, Google, they've all been doing their part to really make that workspace online communication as easy and as accessible as possible to customers. So really what I would say on that one is Motley Fool is recommending Slack, but if that's an industry that you want to get into, you have to go and do your research and figure out what company you think is going to do the best, because I would say there's a pretty high covariance between some of these companies. If one company does well, it may negatively affect another company. I have not calculated the covariance between these companies, but that is something you can go on and calculate, and something we do need to be aware of is that there's probably, I would imagine, a pretty strong covariance between the workspace communication companies. So definitely something to look into there. But those were the 5 recommended stocks by the Motley Fool. Very interesting list. When I clicked on that list, I received it in an email. I was really surprised by it. I wasn't sure what to expect, but definitely wasn't expecting some of these. Nice to see that Zynga is on there, because I already happen to own it. And obviously Zynga being the best one, up 191% over the last 5 years. We haven't seen anything like that in any of the other 4 options. So it's the one that I'm the most excited about from this list. I'm aware I probably have a little bit of bias there because of the fact that I own it, but I was really kind of surprised by these. My issue with some of these compared to, say, something like Apple or Amazon that Motley Fool has recommended before is, what are these companies really doing to disrupt the market space, right? Because Amazon came in and did something that really nobody else was doing. Apple came in and did something better than what everybody else was doing. And I don't necessarily see that marketplace disruption with some of these. Okay, it's gonna be interesting to see how these stocks fare over the next couple months. Let me know down below if you're interested in any of these companies, if you think you're gonna invest in any of these companies, if you're definitely gonna stay away from some of these companies. Let me know down below. But as I promised, I'm gonna tell you how to get a free share using Robinhood. So here's the great thing about Robinhood. Robinhood is probably one of the easiest platforms to use when it comes to starting investing in the stock market. It's the sole reason and purpose that I was even able to start investing when I did. When I turned 18, it was the first thing I did. I signed up for my Robinhood account and I started investing. So Robinhood has some awesome stuff that's related to it. First of all, they have 0 commissions trading. In fact, one of the first companies to start doing that. Robinhood is what really began to make that popular. 0 commissions. We live in 2020. You do not need to be paying a commission per trade in this day and age, and Robinhood is making that a reality. Secondly, Robinhood has no account minimums. You know, other companies have account minimums that you need to have in the account. Robinhood, $0, making it super accessible to anybody who wants to start investing. You can invest in stocks, ETFs, options, cryptocurrencies, and American depository receipts. They've also represented a continually growing platform and company. One of the awesome parts about Robinhood they just added is the ability to invest in fractional shares. So you can invest in any of the companies you love for as low as $1. I mean, there's all these companies out there that we know that we would love to invest in, but who can really afford to invest in a share of Amazon right now? Well, you can for as low as $1 with Robinhood. The other thing that Robinhood offers is they do offer a cash management account at a 0.03% interest rate. Kind of low on the interest rate. You can do better than that, I'm not going to lie to you, but Robinhood does have that option for you if you would like to do so. It's just offering it all for you folks. They have a lot of stuff in there that is great for the individual trader who's really super interested on trading stocks. It's a really great app for that. And of course, the part that you're here for, if you sign up to Robinhood using a referral link, you will get a free share of almost any stock ranging up to $500. That can be anything from Microsoft, Apple, Berkshire B. So many options in there for you to make a little bit of free money. That's infinite returns. You spent nothing. All you got to do, click the link below, sign up, open up your brokerage account, and you will have that free stock waiting in there for you, where you can gain up to $500 in assets per year. All you got to do is share the link with your friends and help them start to get educated and have their money work for them in the stock market. As I always say, please conduct professional financial advice before making any financial decisions, but I do truly believe that Robinhood is one of the best personal brokerages that you can use to get started in the stock market. It's the account that I personally use, and I love them to death. Robinhood, use the link below, get your free share, and start making some money in the stock market. Thanks for watching today, guys, and we'll catch you next time.